It's all good. All right, so today is April 1st, 2024. Last week I had a fellow dealer come in and see me. When he's in the area, if I've got, excess inventory, especially like 40%, half dollars and stuff, and, old like, pre-33 gold that I can't get rid of, he'll buy it off me. He always pays a pretty fair price. So every time he comes in, I learn something new from this guy. And so you see, this is an MS70 Gold Buffalo, right? First strike, blah, blah, blah. First day of issue. Like, why are people going to the trouble of grading these things? I mean, I've got that.
Yeah, they're all perfect.
Yeah, I've got an MS70 10th ounce Gold Eagle, 2009. Not a key date. These aren't key dates, right? Like, why would you spend the money to send it in, get graded 1998, MS70 10th ounce Gold Eagle? Like, why would you go to the trouble of grading these things? MS69, 2005 half ounce Gold Eagle. What's the point, right? Why?
Yeah.
It's for IRAs. It's for IRAs. These are for IRAs, for the IRA companies that deal in precious metals, deal in gold and silver, for them to charge a huge markup.
Huge.
So whoever's doing business with them pays, I don't know, 10, 15, 20. Is that conservative? Maybe let's say 50% premium. I don't even know, because we don't do that. Here's another one. 2018 MS70 half ounce Gold Eagle. That's why these exist. And that's also why proof, so we talked a couple videos ago about proof Gold Eagles. Like, why were dealers a year ago, like, I could wholesale it out for $7.25 over spot per ounce. $725. Why? Like, and I thought, oh, there's just like this one buyer out there is just hoarding it. No. I was wrong. It's going to IRAs. These are going to IRAs. And there's somebody at the end of that line that's paying an insane premium that's getting screwed.
Huh.
I didn't know that. I just learned it. So
it does make sense because because no matter what, that premium's been there. I can't think of a time where that large premium is.
That premium has now evaporated. Like, proof Gold Eagles, like 10th ounce, half ounce, unless they're like key dates, full ounce. Wholesale, I think, is paying $200 over $225 over spot right now.
Really? Is that
it's collapsed?
That's because of the jump.
I don't know. I don't know what's happened. Maybe has one of these IRA companies gone bankrupt, and now that demand that was there is no longer there. I'm just speculating. I don't know, but the proof prices have literally collapsed within the past couple months. I don't know why.
Huh.
I don't know the reason. I just know that, like proof Gold Eagles, they're even proof Silver Eagles. It used to be that you could wholesale out proof Silver Eagles for like $80-$90. Now, wholesale price is like $60.
Yeah, so, I've seen that too.
Yeah. Why?
And it's funny because not you, but I've been to other dealers who still are trying to push for those higher prices for the proofs.
Well, here's the thing: they probably paid a pretty premium to get those in.
They don't want to lose.
And that's the thing with it's kind of like you think like with real estate. It takes like 6 to 12 months for a market for everything to be felt all the way down the line.
Yeah.
It doesn't happen overnight because you have inventory that's been paid for at a certain price. And dealers got to make money, so they'll just keep charging it, wait for the last sucker to buy it. You know? Yeah.
So how's business been in general?
It's picking up. It's kind of a weird kind of in between because the price of gold just keeps moving higher. And last night I texted you. Spot price was $22.60. That was, I think that was Shanghai. I think those are Asian markets. I mean, And then right now, I think it's like 22.45. It's come down. I mean, it'll do.
Still,
it'll.
Kidding me?
In Asian markets, if you follow overnight trading, so overnight for us here in the United States, gold's going to be doing something can be doing something very different in Asia. Now, it's not going to be more than like 1 to 2% difference than you'll see here in the United States, but it will be deviating from kind of that, whatever that fixed point is. And so Sunday nights, it's always interesting to check the spot price. It's just to see what things are, how things are going in Sydney and in Shanghai. So yeah.
But you just check the regular price. You just go to like Amex or whatever.
Yeah. You can. Yeah. I mean, I have I have a certain one that we use. But yeah, I mean, goldprice.org. They're a good one. Yeah.
Powell's talking about the strength of the economy, but does not mention the economy is being propped up by credit card spending and this enormous debt bubble.
Yeah.
So how do you see that playing out?
Well, here's the thing. What Powell's not talking about is Congress. Congress is out of control right now with spending. I mean, we need to get our spending as a country. I'm talking federal government spending needs to be brought under control. I mean, even California is a mess. I mean, California's $74 trillion budget deficit right now. I think 74 trillion. Sorry, 74 billion. Excuse me.
I was waiting for that.
74 billion, not trillion. Mixing it up. Government spending's out of control. And so you've got that. Yeah, you have over $1 trillion in credit card debt right now. What isn't being talked about, though, is, so with credit cards, what's the percentage of those people that are, racking up 25% interest here?
Yeah, fluctuating rate, that just
kills you. There's big offering of credit cards out there that are 4% APR. I'm sorry, 4%. 0% APR for 21 months. So, what percentage of that $1 trillion balance, that outstanding balance collectively in the United States, what percent of that is people paying 25% interest or 0? Because you can do a balance transfer with multiple credit cards.
Yeah.
You can do a full balance transfer, pay like a 2% 2% premium on your balance, and then park it there for 21 months, just make the minimum payment, and you're just 0% interest.
Yeah.
So
the debt is still. I get that, and I have a feeling that people are like, maybe they've done that.
Yeah.
The debt's still there.
Yeah.
You're just pushing it back.
Yeah. So I mean, that's a question to me is like, how many people of that number is just an aggregate number. We don't know the divisions of 0% versus 25% or 30 or whatever. We just know that this number is over $1 trillion. Yeah. And I think that needs to be brought into the conversation, because it makes a big difference if you're paying 0% interest versus 25.
Yeah.
If you're paying 25% interest, Lord help you.
Yeah. I guess the question is, how long can this last? How long can this last with people using credit cards and the debt going up?
I think it just comes back to that. It's like we don't know. I mean, maybe that number's out there. Maybe somebody has broken that down.
Oh, like there's a cliff.
Yeah. Like I don't know. Like with that, 0% versus 20. It all hinges on that. Like how much of that aggregate $1 trillion in outstanding credit card balances. How much of that is the 25% interest that people are paying and the 0%? Because that's a lot of people didn't just make that minimum payment. Say it's like $140, $200 a month.
Yeah.
People can get away with that generally.
What about the national debt? Do you feel like there's a cliff that some kind of point where we're just like a tipping point?
Yeah. So there are other parts of the equation I think that aren't being discussed. And one of those is what's called the carry trade. So what is the carry trade? I think it's a huge element to our debt. We have had a guaranteed buyer in the Japanese investing public for decades. Now that'll fluctuate depending on interest rates. So what the carry trade is, you have an investor in Japan. They take out a loan from the bank. Now keep in mind, Japanese government bonds are 0.5%, 0%. I mean, it just depends. Like I think right now it's like 0.6% is the Japanese government bond. Let's say it's a 2-year bond, maybe 0.6%. I'm just throwing a number out there. I know it's low, and it's lower than what it is here in the United States. So say a 2-year note is 4.6%, right?
Yeah.
So let's say you can take a loan out from the bank, a 2-year loan, at, let's see, so Japanese government bond rate plus 1%. So instead of 0.6, you're paying a 1% premium on top of that, so 1.6%, right?
Yeah.
Okay, so you take that loan out in Japanese yen, and then you go buy T-notes. You go buy U.S. Treasury notes at 4.6. You're making a spread of 3%. And it's just free money, right?
Yeah.
Keep in mind, Japan is the 3rd largest economy in the world. You have a large amount of savings in Japan that are just being invested all over the world. So that is the carry trade. And the carry trade goes back all the way to the early 90s to when the Japanese economy essentially, I don't want to say collapsed, but the Nikkei dropped by like something like 50%. Anyway, so the Japanese economy, was in recession starting in 91. Well, what did the Japanese central bank do? So the bank BOJ, the Bank of Japan, they dropped rates. They dropped rates to 0%. That was the beginning of the carry trade in the 90s. So you had, usually it was Japanese housewives referred to, the rest of the world we'll refer to them as like Mrs. Watanabe. And Watanabe, it's a common last name in Asia. I'm sorry, in Japan.
It's a Smith.
It's like Smith. Yeah, exactly. So the Mrs. Watanabes of Japan saw that they could take out these loans from banks in Japan and then go buy sovereign debt in the rest of the world and make the spread. So that fell apart in 1998, 1999 when you had the Asian financial crisis. And what happened is the Japanese yen, all this money poured into Japan, out of Thailand, out of Indonesia, out of Malaysia, a lot of kind of second tier, not quite third world economies. Their economies collapsed. Money flowed into Japan, strengthened the yen, threw off the carry trade because you need a cheap Japanese yen for the carry trade to work. If you strengthen the yen, therefore it shrinks the spread between what you're taking out in yen and what you're loaning out to other countries. So that shrunk the spread and it killed a lot of the carry trades. That happened in 1998, 1999. So that dynamic has resurfaced.
Really?
Now the exact numbers, I don't know. I don't know what the exact numbers are, but how long has Japan had negative nominal yields on its bonds? This is going back like 7, 8, 9 years, right? So you've had this development in the carry trade, let's say over the past decade. So fast forward to 2022, the Fed hikes rates to 5%, 5.25%. So now the carry trade really makes sense. It makes sense for, if you're a Japanese, put yourself in the shoes of a Japanese investor, it makes great sense.
Yeah.
So why not? So that brings us to the question you pose is, how much of a buyer do we have for U.S. government debt, for sovereign debt, for T-bills, T-notes, T-bonds? Like, what's the demand there? And what are the demand dynamics? I think that is a very big part of the equation. Now, I don't know the numbers, but I understand the dynamics.
Yeah.
And when you have the world's 3rd largest economy that...
And they're benefiting from it.
Yeah, I mean, it's just like, if I was a Japanese investor, 100%, I would do that. It makes perfect sense to me. I think the United States debt market, the U.S. sovereign debt, has more demand for it than we might think.
Yeah.
Just because every other currency, I mean, we're still the sharpest knife in the drawer. Like we're the, we're the least worst of everybody else. I mean, you look at, I mean, the only currency that has done better than the dollar is the Swiss franc. And, all of these currencies, the Japanese yen, the Swiss franc, the euro, the pound, the rupee, Chinese yuan, they're seeing all-time highs in gold. And finally, the dollar is seeing all-time highs in gold. And also the Swiss franc. The Swiss franc is now seeing all-time highs in gold as well. So pretty much all the major currencies, I don't want to say all the currencies of the world because I don't know there might be an exception out there, but to my knowledge, at least all the major currencies and even some of the kind of more second-tier currencies like the rupee, the Chinese yuan, I think you could say is a major currency. You're seeing record highs in gold in those currencies, and so yeah.
Cool.
Yeah.
Cool. That was a great explanation.
Yeah.
I got a lot.
Thanks.
This is what I'm saying. Like, I can't explain things like that.
Yeah.
Okay, let's do one more. I was thinking maybe we'll do one more.
Yeah.
If we have time, one more question, and then do maybe even if it's a 10-minute live stream talking about like look at some of this quick and then talk about the book.
Yeah.
Okay, let's plan. Okay, so here's the next question. Powell has signaled that we need to accept inflation climbing at its present rate. If we do see rate cuts in June, with inflation still quite high, how will this impact the dollar?
Let's rephrase that question. How will this affect gold? And then I'll answer
even better.
And then I'll touch on the dollar. So as I mentioned before, Summers-Barsky thesis. What does that essentially boil down to? Gold loves low real yields on debt. So the more the lower your yields are on, let's say T-bills, like the real yield. I'm not talking the nominal yield, and gold also likes lower nominal yields as well. So say inflation, yearly inflation, annual inflation goes 3%, 4%. You're still making 5.25 on T-bills, so that's shrinking your real yield to 1.25, right? And that's just going off official numbers. We know that the real numbers are actually much higher. Like real numbers of inflation are actually higher in an aggregate, right? We know that, and we know that the Fed is. I mean, the Fed's lying. It's just. I'm sorry, not the Fed. The Bureau of Labor Statistics, the BLS. Those numbers they're cooked. I mean, they're there's all these substitutes that are being put in so that they can bring the inflation numbers, the nominal inflation numbers, it brings them down. And that's been going on since the Clinton administration. That's been going on for about 30 years now. This is nothing new. So gold loves low real and low nominal yields on debt. So if inflation continues to go up, rates stay the same, or like they said, they're planning on cutting rates 3 times this year. So if they're going to cut rates, that's going to do really well for gold. Now, for the dollar, that's a different beast, because the dollar, you can see right now the dollar is strengthening. Yields are strengthening. Everything to do with the dollar is doing very well relative to other major currencies. What could be happening is like what I said before, is you have the best of the worst. And now gold is, I mean, the dollar is still in a horrible situation. We have this out of control debt. We're headed towards 35 trillion right now. 35 trillion in government debt.
Yeah.
I mean, the question is when do we hit 40? I mean, 50. I mean, there's no there's nothing stopping us at the current rate of government spending, and so but it all comes back to, well, what do you have in comparison to the dollar? You have the yen, you have the pound, you have the euro. All these currencies are doing really poorly. The euro, I mean, let's rewind to, I don't know, I lived in France in 2011. The rate of the exchange rate between the dollar and the euro was $1 equaled 1.3 euros, euro 30 approximately. Now it's $1 equals a euro and 8 cents, 1.08 euros. It's come down a lot in 13 years. That's a big difference from what it was. The pound has been coming down for decades against the dollar. I mean, it used to be, what, 2.5?
I remember,
60, 70 years ago. I mean, the pound was the world's reserve currency. Now it's what, a pound 30? Just off the top of my head, to a dollar. The yen has broke that 150 threshold, now at a 151 to the dollar. So that's telling you, and of course, should mention, you always have to remember which side of the equation a currency is on. When they do the conversion rates, dollar to euro, it's dollar left, euro on the right, dollar on the left, pound on the right. With the yen, that's flipped, 150 to 151 to 1. So whenever you see that, you just keep that in mind. So as the number on the yen goes up, that's signaling weakness in the yen, strength in the dollar. Whereas it's the opposite when you see $1 versus euro. So as that number comes down, that's weakness in the euro or in the pound.